Adjunct Professor Moran, Macroeconomics 111. In this session, we're going to introduce the concept of recessionary and inflationary equilibriums. Not all equilibriums are good equilibriums. The goal is to get a full employment equilibrium, a production of output such that it generates employment for to the point where you get the natural rate of unemployment, currently someplace between 3.5% and 4%. But in some amounts of actual output are less than full employment, which would give us a recessionary equilibrium. And some amounts of output are greater than we can produce at full employment, and that will give us an inflationary equilibrium. Let's look at a recessionary aggregate expense equilibrium first. So this is done by comparing our actual equilibrium to our full employment. So let's say this is GDP full employment, and this is our actual current level of output, GDP actual. This would be buying, aggregate expenditures, actual, and this would be aggregate expenditures that would result at full employment. Again, think of this as buying, think of this as making, or income. So all three of our definitions of economics are now in this table, on this graph. So let's say we're at full employment. There could be something has shifted us down to this lower level of output and of aggregate expenditures, and what that could be would be a decrease in the stock market, a decrease in indebtedness, an increase in taxes, or a gloomier prospect for the future, or higher interest rates. Those would shift either consumption or business spending down, so this line would shift down. Now we have a disequilibrium at this point, and making is greater than buying. That means there's going to be an unplanned inventory increase, which is not good because inventory is unsold output. Businesses want to sell output. At this point, businesses would start laying off workers. Income goes down, and we'd be sliding down this way into a recession. Workers don't reduce their spending dollar for dollar, because when they take a dollar loss of income, they'll spend somewhat less, but some of their reduction in spending will come from savings. So this won't be a 45-degree line. You'll float down on this line based on the marginal propensity to consume, the slope of the consumption line. That will continue until making is equal to buying at this equilibrium. But this amount of output is insufficient to generate full employment. You don't need as many workers to produce less output. Now, eventually what may happen is the government, as we're going to learn in a future chapter, the government may step in to correct the situation. And if government spending increases, then at this amount of output, buying will be greater than making. Buying will be greater than making because we're on this side of the 45 reference line. And when that's true, there'll be an unplanned inventory decrease. Businesses thought they were going to sell 10, they ordered 10, but they sold 12. So their inventories fall by 2. And that's good news for businesses. So they'll hire more workers. When more workers get hired, their income will rise. And you won't get a 45 reference line here where the increase in spending equals the increase in income, because part of the increase in income will leak into savings. So as a result, you'll go $1 this way, but less than $1 this way. The slope of the marginal propensity to consume is less than 1. And they will go up this way until buying is equal to making, and we're restored to full employment. This is potentially what the government can do to solve a recession. Increase spending, which will shift the entire line up, and then the invisible hand will take over. Or the economy could correct itself, and at this level of output, the stock market could go up, causing a shift. Indebtedness could go up, taxes could go down, or expectations could be restored to something more positive about the future. Or interest rates could go down, causing business spending to rise. So this could be accomplished either through private industry or the government. Let's say we have an inflationary equilibrium. In this case, GDP full employment is less than our actual. So GDP full employment, and this would be our GDP actual. We're trying to buy more output than society can produce. That's going to send productivity down. It's going to send business costs up. And it's going to cause a higher rate of inflation than would otherwise occur. And that's what they mean by inflationary. So this gap, this vertical gap here, is an inflationary gap, and we're going to measure that in a future lesson. This distance here is a recessionary gap. and measuring it is going to help us solve the economic problem, a recessionary gap. So what could happen here is maybe we're at full employment and the stock market went up, or interest rates, indebtedness went up, or taxes went down, or expectations became even more positive, and the line shifted up, and then buying was greater than making, and businesses tried to make more. But it reduced unemployment below the 3.5–4% that the natural rate of unemployment is today, and it caused us to produce more. But because the resource market is so tight, it reduced productivity, increased business costs, which led to inflation, hence inflationary gap. So now buying was greater than making, and so business responded by trying to make more until we get to this equilibrium. But it's an inflationary equilibrium, and we'd like to go back to full employment. So now the government could reduce spending, which would shift this entire line down, and then making would be greater than buying, and businesses would lay workers off as they reduced their output. And as they did, income would go down. As income would go down, people would buy less. And then you get to this point where making is equal to buying. Or it could be the economy fixes itself, and at this point the stock market collapses, or indebtedness goes down, taxes go up, expectations become more gloomy about the future, and the line shifts, and then you have a disequilibrium, and you move along this line. Okay, in our next unit, in our next session, we're going to review the beginning. We're going to introduce more variables and talk about something called the multiplier.